All right. So for most of this outlook today, I am not going to be, unfortunately, I'm not going to be able to see you because of how I'm doing the screen share. So if you have any comments or questions, please put them in the comment section. I'll check it before I hit the end meeting button on this and in the live, but also feel free to reach out to me by text if you have my phone number, by email, or certainly send me a message on whatever platform you're watching this on. I want to thank you for joining me today for our 2023 multifamily market outlook. It is hard to believe that this is actually the third year in a row, but the third year that I've done the market outlook, and this is something that I hope to continue as the years go on. This is being presented by my company, 317 Capital, and hosted by myself, Kevin Breckenridge. Most of you already know me, but if you're watching this after the fact, or if somebody shares this, of course, if you're watching, do me a favor and share this on your timeline. Much appreciated. Welcome to my world. I hope that we are able to meet one day in person. Until then, let's connect on social media. You can certainly watch this across your favorite social media channel. We are live streaming on YouTube. We're live streaming on Twitter, Facebook, and also LinkedIn. So to move on from there, I want to tell you a little bit about 317 Capital. I'll tell you a little bit about myself, and then we'll move right into the meat of everything. First and foremost, 317 Capital is essentially a private equity firm, and our mission is to create economic and social value through real estate. And the way that we achieve that is twofold. One, from an economic standpoint, that's pretty easy with the multifamily space, or with real estate in general. It's very easy to calculate, returns and calculate the type of economic impact that you have. From a social value standpoint, when you're coming up with missions and visions and even goals, it's important that you are able to measure that. And so our social value, from my perspective, is what we are able to do in terms of contributing, making a positive contribution to society. And so our investor education platform is really the primary vehicle outside of the real estate stuff itself. Our investor education platform is really the primary vehicle that we leverage to be able to add social value. And we believe that, by providing the right level of education, by people obtaining the right level of education, of course, with time, with energy, with effort, with trial and error, you're able to create a new economic situation, a new financial situation for yourself. And that all begins with knowledge, right? Whether it's the knowledge from you obtaining knowledge as a professional, or you obtaining knowledge as an investor. The more knowledge you have, the more opportunities you're able to take advantage of if you're able to translate that knowledge into action. So we leverage our investor education platform to be able to achieve that portion of our mission. And tonight is another example where we are providing education to investors. And the entire goal for tonight is to be able to provide you with the market intel, the market knowledge that you need to have the awareness of what's happening in the market, what's going to be happening, what has happened, so that you can make the various investment related decisions that you have to make. From a vision standpoint, our vision is extremely clear and pretty straightforward, is to become a leading regional real estate enterprise. Of course, when we actually achieve that goal, we can always expand it to a national presence and even an international presence. But right now, we're pretty focused on, just our regional impact. And what do we do? And I talked about the social value piece, but in general, what we basically do is we help entrepreneurs actively and passively invest in commercial multifamily assets so that they can maximize their wealth in less time and with less effort. Now, from an entrepreneur standpoint, we literally mean the true definition of an entrepreneur, and that's someone who is willing to take on risk in order to gain. Now, of course, we take that a little deeper by entrepreneurs and having the entrepreneur mindset, the ownership mindset, the CEO mindset, the business ownership mindset, and equipping and empowering and helping motivate and helping, educate, as well as us learning constantly, but just taking that path, that entrepreneurial path, where we are taking greater control over our lives, and we're not just simply sitting back and waiting for life to happen to us. But that's conversation for another day. So let's move on. All right, so a little bit about me, just a couple highlights. I could tell you, a ton of stuff about me, but I just put a couple things that I felt were interesting for today. Let's see, I've been a real estate professional since 2010. Actually, got my first exposure to real estate as a professional in 2008, midway through 2008. So I've got a long history with real estate, both good and bad, taking my wins and taking my losses. Like you do in the ring, but I'm proud to say that I've been in the industry for a very long time. And I'm just now really starting to feel not only comfortable, but extremely confident just with my own journey and experience and insight and knowledge with the industry. It's a very dynamic industry. There are a lot of different avenues to go down, a lot of different things to learn, a lot of different niches that you can master. So I'm grateful that, I've been able to find my lane and to find my space in this industry. It's definitely can be difficult to do. I've got a bachelor's of business administration from the University of Cincinnati, Carl H. Linder School of Business with the focus in accounting and a minor in international business, heavily considering getting a master's degree in real estate for a number of reasons, but we may end up doing that. Actually applied for a master's in real estate degree back in 2010, 2011. And I only applied to one school. I didn't get in. And the reason why I didn't get in is because they said, hey, you're new to real estate and we want to make sure that we're bringing in people who are going to be dedicated to the industry long term. So fast forward, it's 2023. We're still dedicated to the industry. So hopefully they won't have any more reasons or excuses to close doors on me. And if anybody wants to know, that was Georgetown University. So we've been able to expand our network over time, and we have a lot of friends who have actually gone through that program. Anyway, I was on the Washington, D.C. Association of Realtors Board of Directors for 5 years. The D.C. Association basically was the voice for residential real estate in Washington, D.C., advocating both on behalf of licensed realtors and the community as a whole. Right now, I'm actually as a full-time employee. I actually went back to work in December, and I've had a great opportunity to become an asset and portfolio manager for Clear Channel Outdoor, doing corporate real estate. And in that capacity, I manage a portfolio of real estate assets and leasing, a lot of leasing negotiation and real estate assets, which is actually a pretty unique and interesting field within real estate, and one that I wasn't really aware of, before. So I'm learning a lot there. Definitely a lot on the asset management and portfolio management side, which is out of you look at the span of skill sets that you need and the span of skill sets that you need to develop to be, very successful and to scale at the multifamily side of the business. Having that asset management, that portfolio management skill set is extremely valuable. We've talked about that before on one of our lives, where we were talking about essentially building your investment team, multifamily investment team. You can find that video on my YouTube. Anyway, and another thing, I've been a licensed real estate broker since like 2012. In DC, Maryland, and Virginia. My Virginia license is active. I don't do a ton of stuff in Virginia anymore, but I like to maintain the credentials just because it keeps me abreast of what's going on in the industry. And it took a lot of work to be able to achieve that. So just a couple things about me. All right, so that's it. Now let's actually get into the meat and potatoes of why you logged on. We're going to talk about the industry, the multifamily industry outlook from a couple of different angles. And I hope that I was kind of playing around with the order. So I hope the order of the slides makes sense to you. If they don't, I apologize. But I was just trying to get to the right layout that I wanted. But I think we got a pretty good one. So we'll cover a couple things. We'll cover the economy. We'll cover just kind of what the market overview, what the market kind of has looked like over the last year. We'll talk about some of the things that are taking place and what to expect this year. We'll talk about lending. We'll talk about rent. We'll talk about vacancies. We'll talk about a lot of stuff. And my goal is to get you out of here within the hour. We'll definitely be done by 8 o'clock. I've got a little bit, I got quite a bit of slides to cover. So I won't spend too much time on each, maybe a minute at most, a minute and a half, but also sometimes have a tendency to talk too much, but we have excellent time management. So we'll be out of here by 8. All right. So starting off, economy. Now, with the economy on a national scale, and I want to caveat this, that everything we're talking about tonight is on a national scale. We will talk about some locales specifically in terms of where they rank, what type of numbers they're looking at in terms of new construction and things like that. But this is a national perspective. And it's important, of course, to understand the national dynamics. It's also important to understand the international dynamics. But when we talk about real estate, we're really talking about, of course, you hear the cliche location, location, location. There are levels and layers to the depth of analysis that you have to do. You at the very local level, you have your sub-market, which is essentially your communities. You have your community focus, then you have your city focus, you have your county focus, you have your state focus, you have your national focus, and then again, you have your international. And all of these different layers have different economic influences, they're in different stages of their economic growth and contraction. So anything we talk about on a national level, just make sure that when you're doing your due diligence, you're taking a look at the local level, the regional level, the state level, where you're actually invested, and you're utilizing the same purview and the same parameters that we're using to get more granular, right? We're going from a macro to a micro. So you can use the same lens to kind of essentially break down what's happening in your local market. So looking ahead for the economy this year, a couple bullet points I just wanted to highlight. There's been talk about a recession. Now it seems like for at least a year and a half, everybody's trying to time the recession. How bad is the recession going to be? Are we already in a recession? Et cetera, et cetera. The recession conversation never gets old. But one thing that is important is that companies and consumers are making adjustments in preparation for a upcoming recession, or in response to what they perceive to already be a recession. So from a company standpoint, a lot of companies are laying off people, especially in the tech sector. If you look in the tech sector, there have been a lot of layoffs by the tens of thousands. And on the flip side, consumers are bracing for a recession by tightening up their wallets. They're starting to contract in terms of their spending. They're looking for second jobs. And all of that is mixing together to create a situation where it's estimated that we are actually going to see a negative basically a negative imbalance between the amount of job growth and the amount of people who actually still have jobs at the end of the year. So there will be a slightly higher unemployment this year. That's what's being expected. Household formation is also expected to slow for some of the reasons that we mentioned. You've got people being laid off, but you also have inflation, right? We'll talk a little bit about inflation, but inflation has been hitting everybody hard again for the last year or so, and that's making it more difficult for people to be able to formulate new households. And by formulate new households, we're talking about having kids, we're talking about getting married, we're talking about moving out of your parents' house and into your own place. And I mentioned this earlier, savings accounts. Well, when the recession or when the pandemic happened in 2020 and everybody basically was forced to stay home, one of the positive things that happened for the everyday consumer is that they were able to save more money. And so there was a cushion, a much bigger, the US savings rate had dramatically increased during that period of time. Well, of course, memory is short. Everybody got pent up, energy when we're, when things start to open up, everybody wants to get out again. Everybody wants to spend again. So the pandemic savings cushion that we had has dwindled. Another thing, fuel costs and the volatility with fuel costs. We don't know how volatile fuel costs are going to be this year. We saw some volatility with that last year. There were some things that the federal government was able to do in terms of reserves and negotiations with OPEC, but we don't know how that's going to further impact the economy ahead. And we'll talk about a lot of that stuff and how it essentially all comes together to impact multifamily demand and the multifamily market. Moving on from the economy, looking at the economy ahead, I want to talk a little bit about some of the rent trends that have been taking place and some of the things that we're looking at moving forward. So looking at the forecast for 2023, this is a rent growth by metro forecast. And essentially what you're looking at is giving you what the year over year rent forecast is, or rent growth is for this year compared to last year, and then what the average rent was for each location as of December 2022. So on a national scale, we're looking at a projected rent growth forecast of 3.1%. This is actually significantly lower than what we've seen over the last 2 years or so. Definitely with the pandemic and the environment that created, rent growth pretty much took off. And so you had some record amount of rent growth. But this year, we're expecting things to kind of tailor back down more to what the historical averages have been. So on a national scale, again, you're looking at 3.1%, San Jose, 4.9%, New York, 3.7. I'll just throw out a couple locations. LA, 3.3, Baltimore, 3.1, DC, 2.8. Another telling thing is the average rent, and looking at the average rent as of December. I'm looking at a lot of these average rents, and I can tell you, my mortgage is, is a lot lower than a lot of these average rents. But that's the environment that we find ourselves in. And I'll talk a little bit about the gap between the average monthly mortgage payment and the average rent payment right now. But the difference is dramatic. And that difference actually increased significantly last year. So there hopefully will be some rebalancing out. But quite honestly, I don't know how much things will rebalance out over the course of this year because of the various dynamics that we're still facing in the market. And we'll talk about that as we move on. So looking at rent growth by market type, this is basically looking at your primary markets, your secondary markets, and your tertiary markets. Your primary being like your DCs, your LAs, your New Yorks, your secondaries. If I had to guess, I'd say probably your Jacksonville, let's see, maybe a Louisville, places that are a little bit smaller, not as primary. And then your tertiary markets, your much smaller markets that don't fit basically within those first two. Now, one of the things that's interesting about this chart is you can see between 2019 to 2022, 2023, you can see how much there was in terms of a change of rent growth, but you can also see that there's been a dramatic increase in your tertiary market market growth in your tertiary markets and your secondary markets. And the primary reason for that is because during 2020, when the pandemic happened, there was a lot of mass relocation as people were leaving your primary cities like New York and DC, these big urban cores, and they were moving back home. They were moving to other areas because they were now able to work remotely, or they lost their job. They had to move back home with friends or family. And so you had a shifting of where markets were basically popping, and your secondary and tertiary markets were seeing a lot of growth in terms of renter demand. All right, so moving on from our tertiary markets, we're looking at rent growth by class. There are various property classes, Class A, Class B, Class C. Essentially, what the class is determined by the overall condition of the property and when the property was built. So Class A is going to be your top tier, your new construction, your luxury, brand new, just opened in the last 2 years. Class B is going to be, depending on the market, it could be a 5-year-old asset, a 10-year-old asset, a 20-year-old asset, depending on the condition of the property and where it's located. Class C is going to be your properties that are 30, 40, 50 years old or more, but also are run down, haven't been well taken care of, may be in a rough location, or may just be severely outdated and not taken care of, but in a really good location. Now, with the pandemic, and just recessions and economic shifts in general, what tends to happen is your rent in your Class A declines. It goes down. Your rent growth goes down. The demand for those units go down because people are looking for ways to save money. So they're shifting from Class A to Class B, or from Class B to Class C. So that kind of explains the downshift, the downward shift by class. And then also just seeing that your Class B and your Class C are actually performing better than Class A, because again, Class A is going to be the highest rent that you can pay in the market. And so when people are looking for cost savings, they're going to move to a cheaper location. And so your financial performance for Class B and Class C is going to increase a bit. And then also we have this decline in year over year percentage growth because again, the pandemic created a very unique situation, pent up demand. You also had a lot of people not moving. You had the housing market pretty much frozen. And so there was more demand for rental properties. So those are just some of the reasons and some of the context why. But as you can see in 2023, we're expecting a continued downward decline to that historical average that we mentioned earlier. All right, talking about our capital markets. Capital markets is essentially access to capital. What's going on in the financial markets, the loan market, capital being essentially money. When the definition of capital with an A is money. So when you look at the money markets, how is money moving through the various lenders that make up the multifamily market? So we'll talk a little bit about capital markets. So from a transaction standpoint, this is now, I actually didn't caveat this, but I'll share the sources of information at the end. But this data, the orange, gray, and blue data, whenever you see this graph on this presentation, this is coming from Marcus and Millichap. They have an excellent research department. They publish reports frequently. And so when you're looking for data, there are different data providers that provide continuous data throughout the year. Marcus and Millichap is one of them. So this is from Marcus and Millichap report. Now this transaction activity over the, last 20 years. And it's given us a breakdown of where transaction volume is relative to the dollar amount of the transaction itself. So your dark blue is transactions, multifamily transactions that closed in the $1 to $10 million space. You see that makes up a vast majority of the multifamily transactions. Then that gray area is your 10 to 20 million transaction volume area. And then that 20 million plus actually makes up a sizable section of the market as well. But as you can see, the trends, transaction volume or the total transaction volume has continued to trend up since 2020. With 2020, that basically there was a lot of uncertainty, a lot of confusion, a lot of let's wait and see how the asset performs. Lenders were waiting to see how the pandemic would impact rent collection. And so you had a slowdown in 2020, but immediately it became very apparent and very obvious that multifamily was a strong performer and performed extremely strong during 2020. And so 2021 things were able to kick up pretty quickly. And so you had some very strong years in 2021 and very, very strong years and a very strong year in 2022. Now this chart, these green charts, off green, forest green charts are coming from Arbor. Arbor is a multifamily loan specialist, and they actually provide data on what they consider the small multifamily market. The small multifamily market is going to be your loan balances, your transactions with an original loan balance of between 1 to 7.5 million. Now, the reason why I wanted to include that is because when we go over these market overviews, a lot of times these are typically covering properties that are 50 units and above. So the commercial data is kind of skewed. And so when you're looking at data for smaller properties, smaller transaction values, it's a lot more difficult to find that data because there aren't as many dedicated data sources that are following that segment of the industry. So with Arbor, they have the small multi-balance space and data that they provide. And with a loan balance of 1 to 7.5 million, that allows us to now look at data for properties that may be and most likely are going to be smaller than 50 properties, at least to some degree, depending on the market you're in. If you just say a rough estimate of $100,000 a unit, for $1 million property, you're looking at 10 units, right? Or if it's 50,000 a unit, you're looking at 20 units. So this gives us a nice overview of what's happening in the smaller space as well. Now, for 2022, we saw an estimated 14.3% annual decline from 2021's record high of 94.1 billion. Now, we just saw from a transaction volume standpoint, there was more transaction volume, but in terms of the dollar amount was slightly lower, at least in this space. One of the reasons being is because as the Fed has been increasing interest rates, all right, they started increasing interest rates last year. That started to have a negative impact on price points for multifamily properties. So although you have a higher transaction volume, you also have a slightly lowering of the transaction dollar amount itself. Now, even with that being the case, the origination volume was still 40% higher than it was in 2020, and it was still 36% higher than it was in 2019. So you're still doing and still seeing a lot of volume in the multifamily space. Now, from a cap rate standpoint, on a national average, and this is small multifamily, again, 1 million to 7.5 million, you're looking at cap rates rising in the fourth quarter of 2022 to 5.1% on a national average. That rose 13 basis points from the prior quarter. And that from Q3 of 2022 to Q4 of 2022, that was the largest single period increase in 2009 or since 2009. So what we're seeing happen with the cap rates is the cap rates are going up. There was a period of compression, as you can see from 2019, 2020, 2021, there was a big drop down, slight increase. Cap rates were compressing, values were going through the roof. Then we had the quantitative basically easing, the increase of the interest rates. And so cap rates are now starting to go up, which is having an inverse effect on our asking prices. And it's creating challenges between what they call the ask and the bid price. The price that a seller is asking for their asset relative to what investors are willing to bid or willing to pay for that asset itself. Now, in terms of our cap rates relative to multifamily as a whole, comparing that $1 to $7.5 million loan balance or loan amount, the smaller properties, to all multifamily properties, particularly your commercial 50 units and above, we're seeing that cap rate has remained relatively flat in comparison. It held at 36 basis points, remaining flat between Q3 and Q4, which essentially is showing us that in terms of the risk profile, now typically on your smaller properties, the risk profile is a little bit higher because you have fewer units. So the economies of scale decreases as the unit count decreases. So the less units you have, the higher your risk profile, right? We talk about the difference between single family and multifamily. Single family having the highest risk profile as a rental property because you only have one tenant, and as you have more tenants paying rent, you are able to spread that risk of a tenant not paying rent across a wider swath of units. So what this chart shows us, it shows us that the risk between smaller properties and larger properties is actually not only has it decreased, but it's remained steady throughout the course of last year. All right, so talking a little bit about loan to values. Our loan to values are essentially how much we have to take out in a loan relative to how much we have to bring to the table in order to acquire a property. So loan to values have been shifting throughout the last couple of years with the pandemic. And then with the increase in interest rates. So what has happened is the LTV has actually increased. At one point, it was at 70.5%, which was a Q1 2021 peak, basically meaning that on average, you had to bring, or you could get a loan for up to 70.5% of the purchase price. Where we're at now, we're at 65.4% as of Q4 2022, which is a slightly higher LTV or lower LTV, depending on how you look at it, essentially meaning that we have to bring more to the table in terms of equity to be able to secure a loan. And the reason for that is because, again, I had mentioned earlier, the economic headwinds, the increase in interest rates, lenders and financial institutions are really adjusting and maneuvering to make sure that they are in a safe space to guard against any potential economic downfalls or downwinds, anything that may come. They want to further protect their position as a lender by requiring you to bring more to the table. So this is a historical chart dating back to 2015, just showing the ebb and flow between the, again, loan to value and the amount of equity that you have to bring to the table. So for this year, we're expecting probably things are probably going to kind of remain level. If there's a continued increase in interest rates, you might see a slightly uptick or downtick in how much we have to bring to the table. But right now we're hovering at about 65.4%. Now, I did want to show you basically, and this is a cutout from Marcus and Millichap, I did want to show you who's actually lending. So if you're like, okay, well, I know I got to bring, 35% to the table, but who's actually lending and at what capacity are they lending in terms of dollar value or deal value? So here's a breakdown of the various lenders where you can secure capital from to buy multifamily. You have your CMBS, collateralized backed mortgages. You have your investor driven. I'm not sure how they categorize investor driven. You've got your private market, you've got your government agency, you have insurance, you have international banks, you have national banks, you have regional and local banks. And as you can see, the regional and local banks actually make up a sizable portion. So again, when you're looking for where to get your source of capital, look at your regional banks and then look at your national banks, but also, of course, look at your government agencies, because the government agencies are mandated to provide a certain amount of liquidity to the market. Now, I can tell you with the affordable housing crisis facing the country, they are placing or trying to place more of an emphasis on funding properties and acquisitions that have an affordable housing component, but nonetheless, government agency still makes up a significant part of the pool of available capital. So just wanted to kind of show you that, and also show you how that has the source of capital has ebbed and flowed over the last couple of years. All right, let me do a time check, 7:39. Take a drink of water. Again, if you have any comments, definitely would appreciate you dropping a comment in the comment section. I'll be sure to check those right before we hop off. And so let's talk a little bit more about the market. Now for the market overview, I think we've actually done a pretty good job of going over the market and giving you an overview of what's happening in the market and what has happened. But basically, we'll just kind of continue down that road and go over a few more things. So one thing I wanted to talk about was the expense ratios. The expense ratios is actually data that a lot of your larger data providers don't really cover. So I was happy to see that Arbor covers this information. Again, this is for your smaller properties, loan balances, original loan balances of 1 to 7.5 million. But your expense ratio is basically the percentage, how much from a percentage standpoint, you're spending on your property, or how much you have in expenses on that property relative to how much money that property is bringing in from the rents. So if you have a higher expense ratio, 45, 50%, you're right in range. But if you're over 50%, or if you're looking at a property that has an expense ratio over 50%, then you know that, hey, there's definitely something wrong here. We got to find out, what's going on. Are the rents not being collected, or where are we losing money at on the expense piece? So from a multifamily standpoint, the expense ratio has risen over the last 2 years to a high of 43.5% at the end of 2021. But that number improved in 2022, dropping 95 basis points during Q4 to finish at 41.3%. So again, this is a national average. When you're looking at your financials, you're looking at your trailing 12, then you have a barometer of saying, okay, I know what the national averages are. Now let me see how's my property performing, and why is my expense ratio this much higher or this much lower. So here's a historical chart over the last 3 years, just kind of showing you how the expense ratios have gone up. I can tell you one of the reasons that expense ratios have gone up is due to inflation. The cost of goods and services have gone up, but also the cost of insurance has gone up significantly. So when you look at those expense items, again, you got to look at them with a fine-tooth comb and review them, on a frequent basis to see where can you get a better deal for the same service. Now, I get it cheaper, get a better deal. All right. So moving on, looking at the supply and demand trends. This is for your new construction and your absorption and your vacancy rate. New construction are your completions. That's the dark blue bar. Your net absorption is how many units are basically being absorbed, how many units are being occupied within a span of time. And then you have your vacancy rate. You can see during 2020, there was a slight uptick in the vacancy rate, but really that vacancy rate has dropped significantly in 2021 and was on a slight increase. Again, a lot of demand. There's a lot of pent-up demand from 2020 with your eviction moratoriums, with people not moving around, not doing anything, with people migrating to new locations and absorbing units there. So your vacancy rate declined, but you have a vacancy rate now that is slightly increasing on a national average over 5%, which still is not bad when you look at it statistically and you're analyzing deals. You're always going to include a vacancy rate percentage. So you're going to, a standard, you're going to include 5%. So from a financial standpoint, we're accounting for that vacancy anyway. What we don't want to see is our vacancy rate, go to 8%, 10%, but nonetheless, we're going to account for that in our financial analysis. But that's just, again, a historical viewpoint going back 20 years of how absorption and completions have increased and ebbed and flowed. All right, so here's another one giving us a state of the market. This one is looking at the percentage of people who have paid their rent on time. Now, when we say on time, we mean by the first, right, by the 5th of the month, the 3rd, whenever that deadline cutoff typically is going to be between the 3rd and the 5th before it's considered late. But you're always going to have a percentage of people who pay on time. And then as the week rolls on, as the month rolls on, you typically are going to get that on-time payment percentage up to 90, 95, plus percent. So 81% of units paid on time in January of 2023. This was an 89 basis points improvement from the prior month, and on-time payments have been above 80% for 15 consecutive months, which, definitely was an issue during the pandemic. But even in 2020, although on time rent payments shifted slightly to below 80%, you still had overall rent payments above 90%, well above 90% on a national average. So people were still paying their rent. They just were paying it a little late. This one is millennials entering the home buying age, and there being some deferral there. Now, what's interesting about this chart is it shows what the median age is for marriage. It also shows what the median age is for first-time home purchases. And if you look at the chart, you notice that there is a good 4-year gap or so between the median marriage age and the median first-time home purchase age, which means that people are getting married and they're being forced to live in an apartment, and they're having to delay or even move in with their parents, but they're having to delay their home purchase. And, speaking from experience, I can tell you that typically, right, when people get married, one of the first things that they're going to do is they're going to go out and they're going to buy a home together. So having to wait, I'm sure is putting some stress on households, but the reason for that delay is multifaceted. One, people just are not moving. They're moving more than they were during the pandemic, but people are not moving. The interest rates, with interest rates being as high as they are, you have a lot of people who are not going to move because the existing mortgage that they have on their existing home has an interest rate that's much better than what they would be able to get if they had to go into the open market. Then we're on a downswing with home prices because of the interest rates. And of course, with the recession, so you have a lot of uncertainty, you have a lot of things mixing. And then the cost to rent, right, or the cost to buy has gone up. The literal cost to buy with the interest rate, making it more challenging for people to afford the home that they want. So for them, it's better to stay. It's more preferable, and in some instances, financially mandated for them to stay where they are. All right, check my time. All right, so looking at our supply growth by metro, this is looking at our forecasted deliveries and our forecasted deliveries as a percentage of the overall stock of housing in these particular locations. So from a national average standpoint, there's a forecasted delivery of 440,000 units. That is a 2.9% as a percentage of our overall housing stock. That's about 2.9% growth in housing stock. You look at places like Dallas, Austin. This also speaks to the health of the particular market in terms of population growth and demand for new units. The more new units that are being delivered, that's in response to the existing and the future demand from a population growth standpoint. So that Dallas, Fort Worth, Texas, taking the top spot. Austin, top spot. Texas is in the building, taking a number of the top spots. You've got Georgia, Atlanta, Georgia in the building. You got DC. You got Florida taking up a lot of those top spots in terms of the top markets, and we'll touch on that in a little bit, all the way to Boston and Chicago and Vegas, all the way down to Baltimore. And again, just seeing what the growth is as a percentage of the existing housing stock in that location, as well as just how many units are coming online or are projected to come online in over the course of this year. All right, so let's look at the investment outlook. And this should take us to the end of the slideshow. But looking at the investment outlook, basically what's the opportunity or what things are looking like over the course of the year from an investment standpoint. Here is a cost savings benefit of apartments and how that's becoming very apparent for the average everyday consumer, the person who has to make the decision to rent versus the decision to buy. Now we're looking at this as an investor, so we want to get a sense and have a sense of what is demand like, right? Because we, one, have to fill our units, And then two, we have to be able to keep up with inflation and be able to raise our rents accordingly, so that we can continue to pay, all of the expenses for the property. We can continue to put money aside for future renovations and repairs and things like that. So it's good to know what the demand looks like on the front end, and what the decision-making process is, and the things that the tenant or our resident has to consider when they're looking to rent or to buy. So home prices are capping off a record run. The national affordability gap is at a historic extreme. I had mentioned this earlier. I'll circle back on that in a second. Our top 10 markets are seeing the widest gaps, or what are the top 10 markets seeing the widest gaps? And then the top 10 markets that have experienced the largest change. Now, this affordability gap has dramatically increased over the course of the last year, has really doubled over the course of the last year, to the point where you have your average monthly mortgage payment being $904 more than your average effective rent. And the reason for that being, and again, the dramatic increase in interest rates has caused a spike in just the cost of purchasing, as well as us coming off of a record run of growth, year-to-year growth consecutively in the housing space. It has just become a lot more expensive for people to own. So when you're looking at, hey, do I stay where I'm at or do I buy a house? Again, financially, a lot of people are being mandated that, hey, you just have to stay in place. All right, so we'll touch on the National Multifamily Index. This is a ranking from Marcus and Millichap, ranking the 50 major markets based on a collection of data points, including the 12-month forward-looking economic indicators and supply and demand variables. The index is meant to show relative supply and demand conditions at the market level. Some of the things that the report considers is your projected job growth, your vacancy rates, your construction activity, housing affordability, your rents, asking rents, your historic price appreciation, and your cap rate trends, just to name a few. So looking at this has given us a ranking of our top 50 markets, and Florida, Florida taking 3 of the top 5 market in terms of rankings: Fort Lauderdale, Orlando, and Miami-Dade, and Tampa. Again, some of the things that are allowing markets to increase or improve their ranking: their demographic drivers, net in-migration, their climate, their lower cost of living, their high rates of hiring, their household creation rates are high, low vacancies, affordable rents, and their cap rate trends. Now, again, this is a 1-year snapshot, so this is not meant to say one market is better than the other. There's opportunity in every market. This is just a ranking year to year, again, based on various data points. And that leads us to our disclaimer that it is not designed to predict performance of individual investments. It is only a snapshot of a 1-year horizon. Again, the long-term and short-term dynamics are in play. So you have to apply all of that when you're looking at markets and you're selecting markets and you're looking at investments. And a market's ranking can fall from 1 year to the next. So again, there are a lot of different dynamics that are in play when you are analyzing markets, selecting market, making investments. Here is basically a bear and a bull look at multifamily market transaction volume based on year-over-year change. By bear, we're looking at our top 10 markets, by bull, we're looking at our top 10 markets. By bear, we're looking at our bottom 10 markets. And so that's where you have the rankings of number 1 and number 2. And then you have your rankings of 58, 56, 54. So we have Honolulu picking up number 1, Detroit number 2, Richmond number 3, Louisville or Tulsa number 4. Let's see, Orlando number 5. Again, this is year-over-year transaction volume growth. So just giving you a national spotlight of how things are shaking and moving across the country throughout the year. Looking at our multifamily market cycles, this is from IRR and their viewpoint report, just showing us where are we by market according to supply. And they do an excellent job just showing you based on this color wheel of whether a market is in expansion mode, hyper supply mode, a recession mode, or a recovery mode. And this is specific to multifamily and multifamily data, not necessarily it takes into account the overall economy, but a lot that we mentioned earlier. And so just looking at, the different markets that you might be in, this gives you an idea of where that market may be. I just want to make sure I'm getting through the slides. Record construction activity being mostly aligned with long-term demand tailwinds. If you aren't aware, the country has a housing shortage of millions of units that we need over the next decade and continuing decades in order for us to meet our housing demand, both by according to natural birth and definitely by migration. The country is growing. And so we have a desperate need for construction activity. What this is showing us is construction activity relative to the future or projected growth of young adults. And so anything with a green is above 3%. We expect that those areas over the next 5 years are going to see a significant young adult growth, going all the way to your red markets where you actually see a projected decline of below 5%. So just giving us an idea of where the young folks are moving or where we see young folks growing. By a young adult population, I'm sorry I didn't get the data point on that, but we're going to assume that that's 18 to 25 or so. And then just finally finishing up at 7:56, just want to talk about the sources in case you want to do some further research. Here are the data sources that I use to put this together. Marcus and Millichap's apartment investment forecast, Integra Realty Resources Viewpoint 2023 report, the Yardi Matrix US Multifamily Outlook Winter Report 2023, and then Arbor's Small Multifamily Investment Trends Report Q4 2024. Give you a second to take note of that. And then of course you can always replay or go back. And then finally, if you are interested in learning more about our investment management platform and our investment strategy, you can schedule a no obligation discovery call to learn more about partnering with us on future opportunities. We are looking for investment partners, and it all starts with a conversation. We are regulated and mandated by the federal government, and so there has to be an existing relationship. And in order for us, of course, if we don't already know each other, if you aren't already on our email list, we haven't already spoken, touch base, then that future opportunity all starts with a conversation to see, if there's a mutual liking and a mutual opportunity to work together in the future. You can schedule that by going to my Calendly website listed there on the slide. And then you can also learn more about our team and our company at 317capital.com. 7:58. So we did it. So with that being said, I am going to stop my screen share, maybe. All right. And check the comments real quick. See if you guys left any comments. And I'll tell you, my stomach is growling. It's time to eat. Stomach is growling. All right. So what am I looking for? All right, yeah, my stomach is growling. All right, I think we're good to go. The section I'm looking for, I can't find it easily, and I don't want to hold you up too much. But as far as I can tell, I don't see any comments right now. But if I see anything after the fact, I'll definitely respond. Thank you again for logging on. It is much appreciated. I enjoy spending my time with you this evening and breaking down a little bit of perspective on the multifamily piece. So with that being said, all right, take care. Peace.